What's going on, folks? This video is going to be a lecture talking about on how to identify your weekly and daily bias in the easiest way possible. So this is a part 2 video, and for those who have not watched our part 1 video, make sure to go ahead and watch it before hopping on this one. And for those beginners that are searching for the easiest way possible to identify your weekly and daily bias, this is the right video to go with and learn about and master the algorithmic cycles throughout the markets based on ICT concepts, surely, and everything noted is by me, myself, nothing is copied. And this is going to be as an intro. Let's go through the PDFs to tell you about every single thing you need to know for this. What we're going to go through in the PDFs are 4 types of concepts. The first one is the 4 types of weekly profiles that always repeat. So every single week, these 4 types of profiles are occurring, but not all 4 of them at the same time. And you have only 4 types of weekly profiles that are occurring every single week. The second one is how to use previous week's range for intra-week continuations. So this is a second concept you can use on how you can find out your intra-week continuation, or let's say distribution, only by using the previous week's range and some type of projections. We're going to talk about it later in the video. The third one's going to be how to identify your next day bias in the easiest way possible. So the third one is the one I am always going to recommend the beginners to go with. So there is nothing easier than this. It's only using previous day highs and lows and certain rates that occur. And you are going to learn about this too. And finally, when to avoid a trading day. This was so much requested because so many people don't know how to find the invalidations and they keep getting stopped out even though their bias is right. So going to the next page to talk about the 4 types of weekly cycles, or let's say weekly profiles. The first one is the classic expansion, which occurs most of the times in the market cycle, meaning that Monday or Tuesday forming the low or high of the week. So this forms 60 to 70% of the time throughout the weeks, which Monday or Tuesday form the high or low of the week. The way you can use it in 2 scenarios is if Monday is forming the high of the week or low of the week, I want to see Tuesday displacing the Monday high or low, making me interested for Wednesday and Thursday expansion. So let's say Monday formed a high or low, Tuesday comes in displacing the Monday high or low, making me interested for Wednesday and Thursday expansion. The second scenario is going to be Tuesday sweeps. Here we talked about displacing, but here we're talking about sweeping. Tuesday sweeping Monday's high or low, making Tuesday form the high or low of the week, which will also lead to a Wednesday and Thursday expansion. So if Tuesday sweeps Monday's low and closes in range, I want to see Wednesday to Thursday having an upside expansion. So this is in a bullish scenario. The second one is the midweek reversal. When does this happen? Is when Wednesday sweeps Tuesday's high or low. So here we talked about Monday and Tuesday sweeping highs and lows in these 2 days, but here we're talking about Wednesday. When Wednesday sweeps Tuesday's high or low and closing back in range. So this closure in range is really important. Otherwise, this is not valid, leading to a reversal in the opposite direction. For example, Tuesday closes as a bullish candle. Just imagine it. If Wednesday sweeps the high of Tuesday and closes bearish, that means closing back in range, I want to see a bearish bias on Thursday and Friday. The third one is going to be consolidation reversal. You may sometimes be confused about what's happening usually on Monday, Tuesday, Wednesdays. When they're ranging, you see like a consolidation. You don't see any type of clear direction. So this is called a consolidation. But how you can get reversals and catch reversals in this sequence? is when Monday and Tuesday doesn't form a certain range or a clear move. I want to see Wednesday or Thursday. So these 2 days have to form this type of scenario. So Wednesday or Thursday, rating either all the previous days' lows and highs. What do we mean by all the previous days' lows or highs? The Monday and Tuesday, lower high, and reversing in the opposite direction. For example, Monday, Tuesday, and Wednesday are stuck in one range. That means they're consolidating. So I want to see Thursday sweeping all their lows and expand higher, or Thursday sweeping all their highs then distribute lower. So this is up here is the bullish scenario, and down here sweeping all their highs then distributing lower. This is in a bear scenario. And finally, the Thursday counter. 60% of the time the market distributes on Monday, Tuesday, and Wednesday, and then forms a reversal on Thursday and Friday. So the market cycle 60% of the time moves this way. So Monday to Wednesday is an distribution period for the market, a one-sided distribution. And usually when you have a one-sided distribution from Monday to Wednesday, you want to see a reversal on Thursday and Friday. But you surely should have a sweep of Wednesday's high or low before reversing. For example, Thursday raids Wednesday's high and closes bearish. That means closes back in range. Then I'm expecting Friday to be bearish as well. So this is how you can catch the Thursday counter. These are the 4 types of weekly profiles in image. If you want to see, we talked about the classic expansion, the midweek reversal, the consolidation reversal, and the Thursday counter. Notice, study, and know every single thing I said about these to master the weekly cycles and to stop being manipulated by the market over and over again. How to use previous week's ranges for intra-week expansion. So this was the second concept we were talking about. A new week candle is always, what I mean by always isn't actually always, but most of the times it's gonna have a retracement into the previous week levels. What are the previous week levels? The 20%, 30%, and the 50% of the previous week's range. So you hop on the weekly chart and use the 20%, 30%, and 50% level as projections. And the market most of the times is going to have a retracement into one of those 3 before having a continuation higher, or let's say lower. You're always going to expect a retracement into one of those levels before price distributing. But note something. You have to know this. If price seeks the 75% level of the previous week's range, that means it breaks these 3 and hunts the 75% level of the previous week's range, then I'm not expecting an intra-week distribution anymore. Because in that case, it's a reversal. It's not a continuation anymore. If price seeks the 75% level, I am considering a long-term reversal. I'm not waiting for a continuation. And the most simple way to identify your next day bias, finally, this is the best gem a beginner can use. Pretty easy and simple. Always mark out your previous day highs and lows and wait for a raid of one side, a one-sided raid. Master previous day liquidity sweeps. So we're first talking about sweeping and not displacing. In a bullish scenario, if Tuesday swept Monday's lows and closed back in range, I'm expecting Wednesday to drive back up to Monday and Tuesday highs. But in a bear scenario, if Tuesday swept Monday's high and closed back in range, then I'm expecting Wednesday to deliver back down to Monday and Tuesday lows. But in a displacement scenario, if Tuesday displaces above Monday highs, I'm expecting Wednesday to expand even higher. Bullish bias means looking for longs. In a bear scenario, Tuesday displaces under Monday lows. What do we mean by displaces? I want to see an actual candle closure. I want to see a daily candle close under Monday lows. Then I'm expecting Wednesday to distribute even lower. Bearish bias means me looking for sells. And finally, keep in mind, I mentioned the days. So we are giving Monday, Tuesday, and Wednesday as examples. But it doesn't matter which day you are in. As soon as you see these scenarios, you are knowing what's going to happen and what are you going to do to get confirmation for your entries on a lower time frame. And the certain times you have to avoid trading in. This is really important. I have these 3 points mentioned, and this is what I personally use to avoid trading sometimes. The first one is going to be when previous day high or previous day low has already been taken. You are not going to keep searching for a trade in that same direction. I'm going to give you a quick example. If previous day low has been raided already, I'm not going to be searching for sells anymore. It is done for me, and I'm not going to risk entering the market knowing previous day low has already been taken. The second one is when previous day hasn't swept any important swings. It's better to stay away from trading because in such days a lot of manipulations occur. Price is just in a seek and destroy type of day in this situation. For example, Tuesday did not raid Monday's highs, neither low. So Monday highs and lows stay untouched or has not been raided. What does that mean? I am not going to be trading on a Wednesday. So again, if you're in a day that has not raided previous day highs or lows, you're not going to be interested in trading even in the next day. The third one is finally going to be trading in the last hour of a 4-hour candle. Most unrelated manipulations occur in the last 1 hour before a 4-hour candle closes. So a 4-hour candle takes 4 hours to close. I am interested in trading in the first 3 hours if I see a good opportunity. But if we're in the last hour, even though if I see a good setup, I'm not going to enter till the next 4-hour candle has formed. Because the last hour of a 4-hour candle has a lot of unrelated manipulations. This is when your bias can 100% come out correct, but you're going to get manipulated, stopped, and then price runs back to your take profit. So this is everything we have for the PDFs, and I'm going to hop to the charts, give you a couple examples about identifying your bias in the easiest way possible. So here we are on Gold's daily chart to start off by how to identify your next day bias only by using the highs and lows of your previous day range. So as you can see, we have a down close candle here, and let's wait for the next candle to form. Here we have our next candle. We use the high and low of the previous day, and let's look at how the current candle ends. So we get a closure. You mark out the highs and lows of it and see what gets raised first. Alright, we get a raid of sell side, close down. Alright, so you see a displacement under the previous candle's low. So I'm attending for sells in the next candle. Right here, as you can see, this high stays protected until it raided this day low. Let's wait for this candle. As you can see, low rated. Let's see how the closure ends. Closes back in range. Then I'm looking for buy delivery back up to here. And price delivers to it. Same time delivering into this daily gap right here. So this right here would be the end of your buying delivery. So right here, after raiding this buy stop, buy side delivery, you're not going to be looking for buys anymore. This is where you're going to be avoiding entries. Let's wait for the next day. A ranging day. Okay, we get a displacement lower, as you can see. Okay, I'm looking for the next candle to be bearish since we displaced under the previous candle low. Okay, we went for that low and displaced under. So since we had a displacement under this low, I'm even anticipating for sells to close under this candle's low. As you can see, we had that raid. Now I'm looking for selling delivery again to this low. Okay, we got the displacement lower. As you can see, we displaced under this candle, so I'm anticipating for lower deliveries. Okay, we get a big candle here. Mark out the lows and highs of it. Okay, as you can see, another displacement right here. As you can see, we displaced under the previous candle's low. So I'm even looking further for selling delivery since we displaced the previous candle's low. So this candle should deliver to this candle low as well. As you can see, we did deliver to it. And finally, since this one displaced the previous one, the next one delivered to the low again. So everything that happened in this dealing range, delivering from this high down to this low, detecting the daily bias every single day. This is how you start your top-down analysis. You mark out the previous day's highs and lows and wait for the current day to either sweep or displace one of them. If it sweeps, you're gonna look for reversal entries, like we did here. So this one, this high right here, comes up, sweeps it, closes back in range. So I'm anticipating and trading reversals here. But if price did something like it did here, this low right here, this was a relevant low, came down, displaced under, you see this whole body under. I'm not gonna be looking for buys, but I'm gonna be looking for sells. You could have been looking for sells here, trading back to these lows, resting down here. And this would be how it ended. So beautiful bias detecting. This is one of the easiest ways, if not the easiest way, to identify your next day bias. So this is going to be as an example, and I'm even going to take you to the next example. And here we are on the next example on EU's daily chart. And first things first, as we said, mark out the highs and lows. So this is the most simple way to identify your next day bias, your upcoming bias. Let's see how this candle plays out. This is a ranging candle, so we are avoiding trades in this day, the one right here, unless we see any type of reaction of this high or this low or this high. All right, we sweep it. Do we close back in range? Yes, we do. So I'm interested now in looking for buys back up to this high because we swept this one and came back up, closed in range. So I'm looking for a reversal now. All right, do we hunt this high? Yes, we do. What does the next candle do? It displaces. Displaced it. So now I'm looking for another up close candle above this high. Since we displaced this high, we did not sweep it. How this candle plays out? Does it displace? Yes, it does. So since we displaced this high, I'm looking further even to deliver back up to this high. We are still in a bullish bias, so we are not looking for sells in these scenarios. Does it hunt this high? Yes, it does. Does it come back down and close in range? No, it doesn't. So we're still bullish. Mark out this candle's low and this candle's high. Let's see how the current candle plays out. Does it sweep it? Yes, it does. Does it displace it? Yes, it does. So it didn't sweep it and close back in range. So we're still bullish here. And I'm looking for another bullish candle, an up close candle back to this high. So new week opening gap right here. Price delivers to this high. Let's see if we displace it. Yes, we do. So we're still going to be anticipating and buys back to this candle's high. Price comes up, and displaces it. So we are still bullish here. Let me zoom in a bit. We get a displacement, so we are gonna be looking further back up to the side. A ranging day, so this day neither swept previous day low or high, so this is a no trade day to us. Price raids this high and closes back. So we had a sweep and close back in range. So this right here is our reversal candle. Let's mark out the highs. Let me delete these. And lows of this down close candle. Let's see how price acts here. Okay, we get a raid. Does it displace or does it come back and close back in range? It sweeps it and closes back in range. So notice how you could have caught this reversal of this high. So right now we switched bias. We close back in range, closing under previous day low. So we are going to be looking for shorts after all. So in this case, we had a displacement higher. See how price acts. We slightly swept previous day high. Okay, we swept it but did not close back in range, so we're still bearish. Mark out the previous day low. Let me delete these. And high. And we're looking for a lower delivery here. Does it raid it? Yes, it does. Does it displace it? Yeah, it does. So price immediately came back and swept next day low. What does it do in this candle? Let's see. All right, folks, I apologize for the cut. I was just explaining this and I found out that the recording got cut for no reason. So I'm just gonna explain the small move here. Notice how this next day candle came up and closed, displacing above the previous day candle high, and which after this displacement, we are anticipating in more buys back up to this candle's high in the next day. So as you can see, Monday opened here, a new week opening candle. Right here, you're gonna be looking for lower time frame confirmation, targeting back up to previous day's high, as we displace the previous one to the upside. So this is how to understand and use this in the simplest way possible. I know it's going to be a bit messed up once you start using these, but as soon as your eyes get used to these candles sweeping and displacing one after another, it's going to be the easiest way to identify your next day bias, your upcoming bias. So there is no easier way than this. Right here, it's just marking out the previous day's high and low, waiting for the next candle to either sweep or displace. In this way only, you're gonna know what's the next day gonna do. So, this is gonna be it, talking about how to use the next day bias concept. And I'm gonna show you another example, but the next example isn't going to be about this. It's going to be about how to identify your intra-week continuations using projections. So here we are on NQ's weekly chart to show you how to use projections, the 20%, 30%, and the 50% levels in each candle to actually anticipate in your intra-week continuations. So starting off this down close candle, so here are the projection levels, just for you to mark them out, write them down. These are them, the 75%, 20%, 30%, and the 50%. So in a down close candle, you're gonna mark the projections from high to low, as you can see here. But if you have an up close candle, you're gonna mark the projections from low to high. That's how it works. So this down close candle here, you mark out the projections from high to low. And what do you see here? The next candle coming up, retracing at the 0.5 level and continuing lower. So as soon as price tapped into the 0.5 level, you drop down to lower time frames as you do in your top-down analysis and search for selling confirmation to catch the weekly continuation, intra-week continuation. So in this next candle, we're going to do the same, but I'm going to show you what happened down close candle, the projections from high to low. What did price do here? As you can see, what did it do? It came down, swept previous week's low. It did not displace it. It swept it. Swept previous week's low, came back up, retraced into what? The 75% level. So what did we mention in the PDFs? That if price raids or hunts the 75% level, we are not anticipating in continuations in the same direction anymore. This right here, if it taps it, this is a reversal. We're not going to be looking for shorts after this at all. So what did price do? Touch the 75% level. So we are looking for a bullish reaction on the next week candle. So this candle right here, as soon as it got formed, you mark out the projections from low to high since it's an up close candle. Notice how next week came down, tapped into the 20%, 30%, expanded. Same thing in the next week candle. Came down, tapped into the 20%, 30%, expanded. Same thing happens over and over again, even the next week. Right here, came down into the 20% and expanded. Again, the next candle. So see, this is an algorithmic cycle repeating over and over again. This never fails. The algo never gets updated, and these concepts never get patched. The next candle here came back down, tapped into what? The 50% level. What are we looking for after tapping into this and showing rejection? For higher deliveries. And what happened immediately? Delivered higher and closing above the previous week's high. So mark out the projections on the next candle. Here, the next candle comes back down, taps into the 20%, 30%, continues higher. Even on the next candle, here, you see the 20 and 30% level, how much are they being respected? So price came back down, tapped into the 20% and 30%, and came back higher and closed up here as a down close candle. So this candle right here may confuse you many times, all right? So I'm gonna tell you something. You are never gonna mark such a candles like this. You're never gonna mark it out from high to low. Nope, you're gonna be focusing on the wicks. So if it's a down close candle, you're gonna mark the upper wick from high to low of the upper side of the wick, if it's a down close candle. But if it's an up close candle, you're gonna mark the lower wick from low to high. But since it's a down close candle, here you're marking out the upper wick, the projections from high to the lower side of the wick. And what happened here, if I take you here, sorry, my bad. Okay, make it smaller. If I take you to the 4-hour chart, you're gonna notice something. Where did the week open? So I'm gonna extend this a bit, just to make you see. Okay, we're gonna have it here. So taking you to the 4-hour chart, where did the week open? It opened right here. So you see this red line? What happened as soon as market opened? Price came up, retraced into what? The 20%, and failed to touch the 30%, and continued lower. As you can see, so market opened, came back up, retraced into what? The 20%. And this right here, as soon as it tapped into it, you get your intra-week continuation. Lower, delivering to where? Previous week's low. And what do you notice same time on the weekly chart? A gap. So price delivering from external back to internal range liquidity. So tapped into this gap right here, after tapping into the 20% level, continued into this and freely expanded higher. So in this current candle, how are you gonna mark the projections of it? So from low to high, since it's a up close candle right here, and you're gonna notice a retracement. Your retracement zone is this, from 50% to 20%. This right here is your retracement zone. Keep it in mind. Keep an eye on this, note this, mark this, write it down, whatever you want to do. This is your current week candle projections on NQ. So this is how you can use these projections on every single weekly candle and how you can catch the intra-week continuations. Sometimes you may be like, why is price continuing like that without tapping into a point of interest? Some people here would be searching for a trade back down into this weekly gap on this to be like, okay, when it taps into this, we're gonna be longing. But no, what is price really doing? What is the algo really doing? Retracing into the previous week ranges. Right here, as you can see, the 50%, how beautifully it tapped into it and continued higher. So this repeats over and over again. This never changes. My words aren't even changing ever again. And that's gonna be it for this video. I explained the two most important concepts of this video in these couple examples. I explained how to identify your next day bias, which is the easiest way to identify it. And I taught you here and explained how you can use the previous week projections, let's say range, to catch intra-week continuations. That's gonna be it for this video as a part 2 video. I hope every single explanation I gave comes out useful for you guys. Never forget, don't only watch, start noting and start training on the charts. That's how you get used to these over and over the time. So this is gonna be it, and surely see y'all in the next one. Peace.